Hi, all. This is Dr. J at 11 coming to you live, streaming live from Long Island, New York, where the weather was crisp but nice, where the market stunk today, just like it did 2 days ago. I'm kind of wishing we had had a very bad day on Thursday as well and gotten this correction over with today. Instead, it's going to creep into next week and probably continue through the midterm elections. Yuck. More of this high volatility causing sleepless nights for 401k holders, for pension holders, for pension managers, for traders, for everyone on Wall Street. Oh well, they're getting paid the big bucks, I guess. I'm not. So I'm not going to try to, I'm going to try not to lose sleep over the high volatility, over the downward pressure that we've seen on the indexes. And we're going to analyze again. We're going to take a new look again. We're going to take another look at the SPX, the SPY, the Qs, the NASDAQ 100, the Dow Jones Industrial, and a handful of select biotechs that I think are worth looking at. Okay, having said that, do your own due diligence. My opinions are my own. They do not constitute investment advice. Please check with an investment advisor before following me. Occasionally, Dr. J does have good ideas and is worth following. Having said that, let's get to the video charts. I really should have subtitled this video, Hide the Honey, Honey. All right, let's get to it. We're almost there. Okay, so you should all be seeing my screen at this point. Let's get right to it. Let's start with the SPX or the SPY, whatever. So the reason I want to start with SPY is because that is the most frightening of all the charts. It looks like a five-wave down. Five-wave down would be an Elliott wave impulse, which would mean bear market, that the bull is over. Theoretically, it seems to be conforming. The high on 920 and then a low on 926 would be one wave down. And then going back up to 10.3 would be a second wave up. And the third wave down would be on 10.11, taking us to a low of 270. And by the way, notice the very big red candles, they're indicative of a wave 3. So it is a little scary. Wave 4 up would take us to 10.1, and wave 5 down has not yet finished. When finished, it should be a full retrace, probably, if it is a bear market, of at least down to 255. I think if it's not a bear market, if it's just an ABC type correction, the way I've labeled it, then we probably end right about 259. So the Elliott wave is, I think, would have no choice but to say end of bear market. That looks like a clear-cut 5. Let's take a look at the Dow, which is telling a different picture. The Dow made an all-time high on 10.3. And unlike the SPYs, which made their high on like 921, something like that. So on 10.3 begins wave 1 down, or wave A down. Wave A down ends just 8 days later on 10.11. And then wave B up ends on 10.17. And finally, we're into wave C down, and wave C down has not yet finished. figure it finishes at about at 23,967 or 24,000. And if it followed a nice trend line down, which it's not going to, it would take all the way till November 12th. I feel that with the fury that it's been going down and up, the moves are so great that it'll finish right around the midterm elections. So maybe another week before the turbulence settles in the stock market. And in that case, if it is an ABC correction, then we'll start zooming back almost immediately after that with lots of bargain hunting and so on and so forth, and eventually take this high out. If the doom and gloomers are right, then this is a 1, this is a 2, and we're involved in a wave 3 down. And wave 3 down will finish right around the same location. And wave 3 down will probably be a full retrace actually to about 23.5. And wave 3 down will probably end around the same time as wave 5 down in the SPY. And both markets will start going up. This one in a wave 4 and the SPY in a wave 2. I suppose that's possible because clearly the bear markets don't have to begin at exactly the same time. So if that scenario holds true, we started a bear market in the Dow on 10.3, while on the SPY, let's go back there. Let's go back to the SPY. We started a bear market on 9.20. Of course, that's if, in fact, the Elliott wave principles that I'm trying to follow hold fast. And, you know, do I have great faith in them? No, but I do have, I'm scared of them, put it to you that way. So if it looks like Elliott wave 5 impulse wave down, it frightens Dr. J. And the rationale for the Dow not being in an ABC, wave A, B, C, is that this could be a 1, 2, and then we're finishing a wave 3. So it makes perfectly good sense. On the other hand, I prefer to think that we're in an ABC correction. The optimist in me refuses to accept the fact that we're not going to have fireworks in November and December and January with all different kinds of colors and great big moves up in penny stocks and so on. It just doesn't feel like it's all over. And I mean, I know that's I don't have anything on the charts that say so other than it just doesn't feel like it's all over to me. I know they don't ring bells at the top, but we didn't have this spectacular blow-off top. And I think a bull market of this nature that lasted so long deserves a blow-off top. All right, anyway, that's my feeling on the Dow. The NASDAQ is very similar to the Dow. We're in an A, B, C type correction, heading down to a full correction. And the same thing is true with the Qs. So A, B, C would take us down to a 61.8% correction. It's possible we go all the way down to 154 for a full correction before we continue on up. So Dr. J puts the odds a little bit higher than I did on Wednesday of it being a bear market. I think the odds are probably, what I said the last time, 2-1 in favor of it being an ABC correction, just a correction, and 1 out of 3 that it's a bear market. I don't think it's much different than that. I'm just going to stand with that. 1 out of 3 chance that we've seen the tops in all three averages. Yucky poo if that's the case. That would make me very upset. But we're only going to know that with time, whether or not that's the case. There's no real way of being sure that we're in just a correction and that the bear is not over. And there are plenty of people now coming out of the woodwork saying, bear market, bear market, bear market. So gurus that some of whom have had good calls. So it is a little scary. I'm still going to be on the optimistic side and predict 2 out of 3 chance, just a correction. CVM is correcting nicely for those who want to buy. I think it's holding pretty good on that 50% line, so that it looks like you can buy this Monday. Try to get close to that 50% line, which is about 262. Shed another dime off of this, another 4%, and you got a really, I think, a good bargain. If that doesn't hold, then the 61.8% correction at 221 will likely hold, or possibly earlier than that, this particular low at 250. So we have a lot of possibilities: 262, 250, what is this again? It's around 220. All right, so CVM, if you like the prospects of its head and neck cancer trial being successful, and I think there is a reasonable good chance that it will be, the data will look good, then these are super bargain prices. If the data readout is good, forget it. You got yourself a bargain. All right. Now, of course, it's a small little word called if. On the other hand, ATNM has fallen apart over the last week or so. It's given back an enormous chunk of territory from a high of 926. The high was 86.5 pennies. And it's given back so much. It's 63.97, 64 pennies. So we've given back a lot, and we're back in this long channel, this long-term channel between 60 cents and 68 cents. And who knows how much longer we're going to languish in here, I suppose, until we get news of data. The news of data is positive, I'm sure will propel greatly blow past that high. The news of the data negative enough, and we will see the lows again. So right now, we're about at 60 cents. We're probably a fair bet, because it's either going to go well above 90 or below 30 probably. It's a boom or bust situation. I think if it booms, it'll be sonic. So you'll make lots and lots of money. And if it busts, well, we all know the story of biotechs that bust. We've all been there, unfortunately. And most of us have had some of the positive experiences as well, with some that have been taken over and so on. I've been in the last 8 years in at least 5 biotechs, or about 5 biotechs that have been bought out. Some not for spectacular multiples, but I made money on all of them. Athx. Okay, Athx is back in this very boring 4-month range between 210 and $1.85. The reason I haven't shown Athx's chart in a long time is because it's a yawn. The only time it got a little exciting was for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days when it hovered above the 210 line. But it never broke free of it. So it never broke free of 210. It had all these touches. which was not a good sign. In all these days, it couldn't free itself of that 210 level. Okay, so we're back in the old rut. And again, we're waiting for news. We're waiting for news from Gil Van Brocklin, CEO of athx, who will undoubtedly tell us about future partnerships, current partnerships, no, new partnerships or extended partnership arrangements with Helios or maybe other companies. The main indication, of course, is for ischemic stroke. Multistem is being in a phase 3 trial in Japan with its partner Helios KK. So we're waiting news on how that's going. We're waiting news on expanding the relationship with Helios. We're just awaiting news. And that's why for 4 months, we've gone up and down between $1.85 and $2.10. And that's why until we hear from Gil Van Brocklin, one way or the other, hopefully the right way, this will stay in this little rut. Once it breaks out, however, look out above, not look out below. This 6-7 high will disappear quickly as it soars into the atmosphere. Athx has enormous potential, enormous market in ischemic stroke. Should it become the standard of care, multistem become the standard of care instead of the blood clotting drug, whatever it's called, ATP or whatever the initials are, then this will really soar into outer space. Okay, on the other hand, a failure in Japan would be devastating to this stock. So again, it's similar to all the other clinical stage biotechs. We hope, we wait, we pray. What else do I have to say? Okay, so here's a little summary. I can't say for sure, no bear market, but I still think the odds favor just a correction as opposed to a bear market. Does that mean that we're definitely going to avoid a bear market of 20% pullback or more on the S&P, Dow, NASDAQ? No, of course not. Nobody can really predict that with certainty. And if we do get that 20% correction, if we do trace out 5 waves down in the Dow, 5 waves down in the NASDAQ, as well as 5 waves down in the S&P, then you still don't have to panic. Why? Because according to Elliott wave theory, you're going to get a powerful wave 2 up, and you'll have plenty of time to sell and reduce your holdings during that wave 2 up. So keep in touch with Dr. J. Dr. J will let you know whether we've entered bear market territory according to Elliott wave theory, according to other theories. Sometimes it's difficult to really define a bear market versus a correction. So we're going to look at the nuances there. We're also going to look at a bunch more biotechs that we've been talking about. So please subscribe to this channel if you haven't already. Please like us. Please give me your comments. Please, what else? Share the link. That would help a lot. Get other people interested in hearing what Dr. J's wisdom of the day is. Not every day, because lately I've been saying, well, Tuesdays I like to go to New York. I like to go to the big city. I don't always get back in time. In fact, I usually don't. But sometimes on a Thursday, I'm gone all day and might miss. So it's not my job. I don't have to broadcast, but I sure will try. So I don't like to leave people in the lurch. I just want to let you know that sometimes on a Tuesday, often on a Tuesday, sometimes on a Thursday, you might have to live without Dr. J. Adios, amigos. Sayonara. Ciao.